Okay, so right now people are wondering, why is the market still moving higher? Why is the S&P 500 still moving up, the QQQ still moving up? Isn't the market overextended? Right? Aren't we overextended? Shouldn't we be retracing back? Isn't this a mean reversion? Why are we going higher? So today the macro report, the newsletter, by the way, will be link in the description, link in the bio, live on YouTube. I appreciate you guys who showed up. And if you want to see, like I said, the charts, go ahead and check them out. They are on YouTube. And what up, Hassan? How you guys doing? What up, Ronnie? How you guys doing? We're gonna get through this report, and then we'll go through Q&A. We'll check out Q&A. A lot of bullishness here, even though the picture seems still negative. So let's jump right into it. Okay. So the playbook is, when I'm looking at this market, I hear you hear Powell speeches, Biden's coming out. In the playbook right now is Powell's raising rates while Biden keeps spending. So who wins, right? It's Powell versus Biden. A lot of people seem to believe that, Powell is upset because Biden keeps spending because inflation is going lower. That's exactly what's going on. They're coinciding. They're working together. And I think this is the playbook. And the market is sniffing this out. And the market keeps going higher. And we're seeing more market breadth, by the way. And this is why stocks win in this scenario, because as Powell raises rates, right, inflation becomes more tame. As Biden keeps spending, he pumps earnings growth, right? More government spending fuels earnings growth. So this is the playbook, and then we're going to keep seeing this playbook take place. First chart here, Dow Jones Industrial Average, right? Dow Jones is a reflection of the value stocks, of more economic stocks, not necessarily tech, and 52-week highs, right? Dow Jones, 52-week highs, just went on a 13-day winning streak, which you only see in bull markets. Dow Jones Transports, also 52-week highs, right? And transportation typically goes up higher. The industrial side of the economy is being lifted because of the government spending in the industrial economy, right? Kind of makes sense, goes hand in hand with each other. So mixed recovery, right? We're seeing a mixed recovery here. It's not just big tech. It's not just one or two stocks. It's not just one or two sectors. Rate hikes are going higher. We see the rate hikes have been, all time. By the way, these are the fastest hikes in history, the fastest interest rates we've seen in history from the Fed. So interest rates have gone up, but we see ITB, right, the ETF for home builders, all-time highs, breaking out. How is that? SMH, chip stocks, right, semiconductors, breaking all-time highs. Regional banks should have crashed, higher rates, but we're not at all-time highs, but recovering, okay? So you're getting, and this is basically the market in different sectors is sniffing out the end of the hiking cycle. It sees the end of the hiking cycle. Inflation is making progress because the rate hikes, and inflation's making progress, and we'll get to that. And there's a lot of good evidence that shows inflation is going to continue to make that progress here. All right, we're seeing clear sector rotation past 5 days. So this past 5 days, this past week, we have communications leading the market. When we break down the S&P 500 by sector, communications leading the market last 5 days. Energy, number 2. Materials, 3. So there is market breadth, right? The rally is expanding. Spreading to, and this rally is also spreading to emerging markets. So investors want, because we are seeing global ETFs bid higher. We've seen that, right? Japanese Nikkei, all-time highs. South Korea, Indian, Mexico market, Brazil. There's a lot of global ETFs that are also moving up, our global indexes in other countries. So the US or whoever it is, they want exposure to that. So we are also seeing 52-week highs in Brazil, Mexico, India, South Korea, Japan. And these are emerging market ETFs. So they're ETFs from the US, and they're basically getting exposure to these other sectors, these other global stock markets. All right, so we're seeing that expand, okay? And then when we look at the debt market, we see a preference for equity debt over government debt. That's risk on, right? Equity bonds. Oh, I wrote that wrong. That's really messed up, but it should say, no, that's right. Equity bonds, not treasury bonds. So there's an investment, there's an appetite for risk in equity bonds or equity debt versus treasury debt. And we see that in the triple B spreads inversed. So we just inverse the chart and it's breaking out, right? It's breaking out. So you're seeing more risk being taken in equity markets and stock markets versus treasuries. So the bond trade might be dead. Maybe the bond trade is dead. There's not a whole lot of there's not a whole lot of flow into US treasuries. It's there, but again, like we've said before, we talked about this throughout the week. The macro inflation is making progress, but growth is increasing, right? And this is Goldilocks. This is sort of I think the big signal for the market is we're running into Goldilocks. And if you're in Goldilocks, you don't want to be long US treasuries, because why get treasuries when growth is expanding, right? Why get and also in the same breath, right? In the same thought process, there's not a whole lot of risk. The risks are evaporating. So US treasuries are usually a flight to safety, but the dollar's been that flight to safety, and even the dollar's selling off, and we'll get into that later, right? So Goldilocks, what is Goldilocks? It's when growth is accelerating at the same time you get inflation decelerating, and that's what we are seeing here. That's exactly what we're seeing here. Growth accelerate while inflation decelerates. I still believe we're in the wave two FOMO. The economy is expanding while inflation contracts. There's a lot of dry powder and a lot of reasons to chase. So let's dive a little deeper into that. First, core PCE, right? The Fed's preferred inflation gauge just came out this week. We got the Fed's preferred inflation gauge, PCE, right? Personal consumption expenditure, what it's called. To make it simple, it's the Fed's preferred inflation gauge. It's what they want to see. And that year-over-year chart saw the largest month-on-month drop, right? It's not month over month, but it's month by month. It's a year-over-year chart, but we saw the largest drop from peak. So I think, and this is core, by the way. This is not just headline CPI. This is core CPI. We saw the largest drop in core in June. Okay, we saw the largest drop in core in June. This is X energy, X food. So we're seeing the sticky part of inflation unstick itself. That's happening. Now, over the past 3 months, right, this chart is basically PCE, so not core, but we're looking at PCE, the Fed's preferred inflation gauge year over year. We're looking at the past 3 months by item, by line item, not just the whole index, by line item. So what are we seeing here? We're seeing disinflation, seeing some deflation where prices are going negative, right? Inflation is actually going negative, prices are dropping, and we're seeing only one component inflate. Just, almost no inflation here. So overall, right, just so you know, the PCE was at 4.32 3 months ago. We got to 2.97. So basically 4.25, a little over 4.25 down to 3. So there is progress being made. Core dropped 50 basis points, about half a point, but core is making progress also, right? So in orange, right, or let's start with blue. In blue, you have deflation. So prices are going negative in goods, durable goods, and non-durable goods. We're seeing that over the last 3 months, right? We're seeing deflation there. Over the last, now, same thing in orange, we have disinflation. So prices are starting to cool off here. We're basically seeing prices cool off. Inflation is cooling in services, housing, healthcare, transportation, recreation, right? And then other services. And there's one component, okay, financial services, that has actually inflated over the past 3 months. So maybe that's a warning sign, but it's one component, right? We're going from inflation to disinflation to deflation. Hopefully we stay in disinflation, because that means growth is still growing. And I think that's where we're going to stick. That's what we're seeing. So inflation is evaporating, right, as the economy recovers. Now, here we go. The rally is broadening. So as the rally broadens, right, we've already seen that the rally is broadening and inflation is falling, but global fund managers still remain underweight risk, right? They are overweight cash and underweight risk. This is Bank of America Global Research. Professionals are still cautious about this rally. And I think a lot of it is because they can't move money as fast. It takes them longer, and they're waiting for a giant pullback. We've seen every pullback so far in the S&P has gotten bought up, right? We're seeing pullbacks on S&P, whatever it is, NASDAQ, tech stocks, they're getting bought up. So there's still a lot of cash. And this is why earlier we said there's a lot of gunpowder left. There's still a lot of powder left, right? The FOMO hasn't fully played its way out as much as you might think it has. It has not played its way out yet. Okay. And on top of that, Wall Street strategists stick to a cautious equity view, or basically Wall Street's the most bearish that they've ever been for a second half, right? So in the second half, we're talking Q3, Q4, this is the most bearish on record for Wall Street. So why are they bearish? Because they expect a recession. They expect inflation to come back. And if that doesn't happen, what does that mean? That means all that cash comes back. That means that cash FOMOs back in, and we can track this progress every week, every month. We're tracking the data. We'll see what Powell said. What is he actually looking at? We're going to keep track of that. And we're seeing that there is pressure for these Wall Street analysts, these professionals, to FOMO in, to get in last. All right. And two, looking at positioning, right? Looking at sentiment. This has been the story. Positioning is offsides. This has been the story here, right? Regardless of the macro, the fundamentals, whatever it is, when positioning falls, FOMO's in, market psychology, stocks go higher. And then when the actual inflation is improving, that's going to cause more FOMO. When earnings bottom, which we'll get to next, you get more FOMO. You get more, forced in. You get people waiting for those pullbacks happen, and they come right back in. They want back into the market. And this is by JP Morgan here. Are you more likely? So they're asking, they're asking respondents here, are you more likely to increase or decrease equity exposure over the coming days or weeks? 17% are planning to increase their exposure, equity exposure. Not much, right? You see from June 2021, which is basically the height of the bull market, the last bull market, the peak, that was at 55%, and most people are offsides. Most respondents are still bearish. They're still waiting for the signal. Although the market is up 20%, right? And some stocks up 100%, making 52-week highs, making all-time highs, they're still waiting for the signal. What is it? Inflation's progress, right? Biden is printing. I think that's what it is. You're getting fiscal policy. What's going to force them in? They're waiting for the big crash. The yield curve's inverted. The housing market should crash. I mean, there's so many risks that are just evaporating. And that's why we're here. That's why we're going over this data, right? So Wall Street's extremely negative in the face of Q2 earnings starting to bottom, right? That's what we're looking at too. We might be bottoming here. Now, this is very important because the biggest bear on the street, right? Probably the smartest bear on the street is Mike Wilson. And he's calling for, he said he's wrong, right? He's already pivoted. He's calling for a big earnings recession in Q3, Q4. So we're tracking that, right? If he's wrong, we expect more of that gunpowder to come into the market. So Q2 earnings are bottoming. That's what I have here. 64% of S&P 500 companies have beaten revenue estimates for Q2, which is below, this is revenue, right? Top line revenue, which is below the 5-year average of 69% and above the 10-year average of 63%. So, it's not great. By the way, only half of S&P 500 companies have reported. So we still have 2-3 more weeks, right? We still have Apple, Amazon to report. But so far, as we track the data, 64% are beating top line revenue. We don't expect revenue to be that great because obviously growth has been falling. Even though GDP is beating expectations, growth is still, I call it, growth is still cooling slowly. So top line revenue isn't going to be tremendous. The real question is, what we look at here next is earnings, margins, EPS estimates. And what we see here, 80% of S&P 500 companies, 80% of S&P 500 companies have beaten EPS margin estimates for Q2 above the 5-year. So this is above the 5-year average of 77% and above the 10-year average of 73%. So this is a lot stronger. This shows you that S&P 500 companies are retaining their earnings. This is the bottoming of earnings. If we keep this up, if 80% at the end of the next 3 weeks, at the end of the earnings season, if we keep this up, if we're beating estimates at 80%, then that tells you the market was very resilient. The stock market, equities, companies, very resilient with their ability to retain the revenue. And if those are bottoming, wow, that's going to cause more FOMO. Okay. So if earnings continue to beat estimates, wave 2 FOMO, right? Wave 2 FOMO. Now let's turn to GDP, because this is the Goldilocks. This is Goldilocks where inflation decelerates and growth is starting to reaccelerate. So what are our signals here? Okay. I think the economy is recovering. GDP growth is bottoming, as well as durable good orders. And, durable good orders have an economic lead on the market because they're orders, right? They're looking into the future. They're actually durable goods. So items that last longer than 3 years or up to 3 years, those goods orders, and we are in deflation in some of those components. So are they starting to bottom here? And what we see is that there's an economy, there's obviously a recovery in GDP. So let's track GDP first. GDP, you can see the arrow, we're starting to turn back up. GDP is actually getting revised up. It's beating expectations. There's more growth coming in the economy. And I think, obviously the fiscal policy, right? The White House is spending money, and they can continue to do so as the Treasury general account continues to get filled. And we'll talk about that later if you have questions about it. Durable good orders also starting to bottom. So we see GDP bottoming, durable good orders starting to bottom, and it looks like GDP is just showing us a Nike swoosh recovery. We're seeing that, right? This is obviously the last 3 quarters. The last 4 quarters counting this one, and GDP is starting to come back up. So it looks like it's bouncing here. This would be the signal that there is no recession. And I think the Fed agrees, and they said they agreed on Wednesday, right? So demand is back. We just saw the largest jump month on month durable good orders in 3 years, right? Not for 3 years, not since the pandemic, right? Right after, obviously, because we had all that money coming to the economy. So we saw the largest jump in 3 years for durable good orders. So I think the manufacturing sector is starting to recover here. And we'll see later if that actually plays itself out in the ISM PMIs. Now, the housing market. The housing market is starting to recover. We see new home sales, right, starting to rise on a year-over-year basis. Pending home sales starting to rise on a year-over-year basis. Okay, still in recession territory, but bottoming out. And that's probably why we see ITB, which is the home construction building ETF, breaking to all-time highs, because the market leads, prices lead the economy. Now, just to take a look into, this is a little fun here, taking a look at home prices, they are decelerating, right, post-pandemic. So we're looking at the post-pandemic here, post-pandemic peak here. And in red is the prices that have declined the most. In green are the prices that haven't really moved. So we're seeing that the sticky housing prices are in Cleveland, Chicago, Detroit, New York, Atlanta. That's where prices haven't actually moved since the peak of COVID, right? The peak COVID price, basically. So post-COVID, where those prices peaked, they still haven't moved. But on the other hand, you have, regions that have actually fallen significantly. Seattle down 11.25%, San Francisco down 11%, Phoenix down 8.5%, Las Vegas down 9%, Denver down 4, almost 5%. And that's from the peak. So shelter is not as sticky as we might believe. Shelter is coming down in different areas, right? It's just going to take time. It's one of the most lagging indicators. And that brings us to the next one. Shelter will eventually unstick the sticky part of inflation, causing more FOMO. Zillow rents, falling tremendously. S&P 500 Case-Shiller National Home Price Index, which is basically the metropolitan areas, the biggest cities. If you look at the average home price of the average home prices are decelerating. That's in negative territory. All right. On to the consumer. Consumers are healthy. Consumer confidence, right? So there's 2 measurements. We have consumer confidence and consumer sentiment. The difference is consumer confidence has to do with employment. There are surveys about employment and their ability to spend. Consumer sentiment is more of how they feel about durable goods consumption. And what we see is both confidence measures, sentiment and confidence, are both on the rise, right? So the consumer is, going to keep spending. We look at it, and this might be part of it too. Inflation expectations the next 12 months in red. In blue. Next 5 months, next 5 years in red. So those are pretty flat. They're falling, right? They remain low. So expect from the consumer, inflation expectations are lower for the next year and for the next 5 years. They continue to fall. Now, if oil prices go up, obviously this is going to tick up a little bit. But for the most part, I think it's just going to stick where it's at, right? It's inflation is coming down. It's making progress. Now, I know people are flagging, oh my God, this weekend spending slowed, or, is the consumer in trouble? Well, if we look at disposable income and the savings rate, they're pretty much neutral, right? They still remain positive. 70% of the economy is driven by spending, misspelling word there. 70% of the economy is driven by spending. Consumers have income and they have savings. Maybe this last month the savings rate went down a little bit. Well, they spend a little more, right? It's summertime. They're spending a little bit until we see a trend take place where savings are declining, incomes are declining. Then we might have, we might want to flag that. But right now, disposable income is still positive and it's higher than it was in 2022. Okay. The savings rate is still higher than it was in 2022. So the consumer is healthy. Now, we just had a Fed meeting. Okay. We just had a Fed meeting. And the question is, what did Powell actually communicate? Right. So Powell's language was very optimistic about the economy. He talked a lot about being data dependent. And the key, some of the key takeaways there were no recession in sight. So they don't see a base case for recession. Their base case is no recession. They acknowledge that the housing market is actually starting to bottom here, right? We will stop hiking. Now, this was interesting. He said that we are actually going to stop hiking before 2%, because they asked him, when do you plan on hike? Are you going to wait till 2% to stop hiking, to pause? Are you going to wait? When will you cut rates? And what he said was, and maybe you don't believe him, he said that we're going to stop hiking before we get to 2%, and we're going to actually cut rates before 2%. So how soon do we get there? If we get to near 2%, the market is going to see that and bid higher. There is no recession in sight. So the market's going to keep chugging up as we get closer to 2%. Now, maybe, hey, oil prices, again, we'll go over that risk. If they keep elevating, then that might not be the case. We could see it where, headline actually goes up and core falls, right? Either way, man, this thing did not catch my spelling errors here. This was Grammarly. I'm gonna have to sue him. Incredible progress on the latest CPI. So Powell did say there was a lot of progress on the latest CPI print. And, I think the market did like that. So it did sell off a bit, and then we came right back up. But so far, the meeting optimism, it is matching what we talked about last week, which is his language is becoming more optimistic about the economy and more dovish when it comes to rate hikes. We're at the end, right? We're near the end. So he said we're data dependent. We're going to focus on economic activity, the jobs market, and inflation. And that's why we cover this every single week, because we want to know more insight. We're going to front run the Fed. No, I'm just kidding. We're basically tracking the market. We want better data for you to make better investing decisions, for you to understand maybe your trades, and just to educate yourself. That's the most important part, right? So what Powell's looking at, we're looking at the same thing. Now, the big macro bets that I'm making here, okay, this one is pretty easy. You take everything we just talked about, you simplify it here. If the dollar's been basically, inversely correlated with the S&P 500 or with risk in general, right? Obviously, you can see that dollar goes up, our dollar goes down, stocks are up, dollar up. And I don't mean like day to day, but over the trend, dollar breaks out, stocks decline, right? Because they have this inverse correlation. It's not 1-to-1, but it is telling us something, right? So what I think is happening ever since the bottoming in October is that dollar is the biggest safe haven, right? It wasn't bonds. It definitely wasn't bonds. It was the dollar, because everybody wants to hold the dollar. You're going to get cash on it as they increase rates. And, the dollar doesn't really fluctuate much anyway. So that safe haven in the dollar has been deflating, and it looks like it's just going into the S&P, or it's just going into equities, right? Maybe it's going into crypto, whatever it is. It's an inverse correlation. So when the dollar actually breaks down, that's going to be risk on. We're likely going to be at all-time highs at the S&P once the dollar really starts to break. Who knows what that level is? 96, 95? But I think that's where we're headed. And why do I think that? Well, dollar longs are starting to cover. So this is positioning in the US dollar, right? And positioning is unraveling. We're starting to see positioning unravel in the dollar, and it really coincided with the peak in the dollar, right? The peak in positioning was the peak in the dollar. So the dollar trade is coming off because inflation is lower, no more safe haven, equities look better. We're seeing the market breath come in. There's no economics uncertainty. Well, there is, but the recession is not looking like it's going to happen. So the dollar is unraveling, right? The dollar trade is unraveling. Why seek a safe haven when you're going to benefit when Nvidia is up 100%, when Apple's at all-time highs, when Google's up, when AI narrative is taking over, when, there's just the government is spending like crazy, trillions of dollars, when the Fed is near pause, when they're about to flip over the next 6 months. So the dollar is unraveling, and that's going to kick asset prices higher, right? Now, risk off. This is the biggest risk. We talk about this every single week, and we're tracking it. It's actually been playing itself out. And this is oil, right? The cost. I mean, oil prices are the biggest input to inflation, right? There is no sign of growth collapsing, but there is inflation staying a little stickier. So as long as we stay below 84, 83.50, I think it's okay. I think we're going to be okay. I think yields trade sideways and we're okay. Now, if we get above 84.50, we start to really break out. And this is a very bullish breakout on oil. It's just starting. It is just starting to move as far as the technicals. So, I'm not delusional where, oh, we're going higher no matter what. If this thing really starts to rip, inflation is going to go higher. Okay, the cost of energy will rise. Maybe core collapses, but the cost of energy will go up if it really starts to rip. And that's the biggest concern I have. That is the biggest concern I have, and we'll track that on a daily basis. The fundamentals of oil, the technicals, and the rest of the macro. All right. Now, position trades, right? This is just for fun. Here's some positioning, and I'll go over questions right after this. So position trades, right? Here's what I got for the catch-up trades. I like Zoom video, right? We're getting above that 20. I think this is the 21 EMA on the weekly chart. I think Zoom is starting to peek its head. It should have, if it does have good earnings, I think it explodes. We're starting to see riskier assets explode. There's a lot of market breadth, right? Dow Industrials are up. Everything is coming up. ARK is breaking out. And if ARK breaks out, a lot of these innovation stocks will break out, especially if they mention AI. And you see in the RSI is barely getting above halfway. So I think Zoom has a lot of room to run. Big catch-up trade for Zoom. Teladoc. And if you guys want to look at these, we can, I'll dive even deeper onto the actual technicals. Just throw it in the chat and then we'll come back to these. But a Zoom, yeah, we got Zoom there. Teladoc just made a big move after earnings. They're still negative, but they made a big move after earnings. They're above the prior resistance level. It's not over yet, but hey, as long as Teladoc can hold that level, right, that we're looking at, and I should get into the technicals on this, right? Let's dump into Teladoc. Actually, let's dive in here really quick. Okay. And if you have something you want me to look at, I'll look at it really quick. But oh yeah, this needs to be wider. We'll stick to this, right? I think we can see that. All right. So Teladoc got above the prior resistance, right, at 26. This has a really good options chain, and this thing can move. They're increasing their guidance on customer. Their costs are lower. That was the key. Guidance a little up, and the cost of running business lower, so better margins, right? And Teladoc has a long way to go. It peaked out at around 300, 315 on the last cycle. Does it go there? I don't know, but I like the technicals. Very strong bottoming at 23. Maybe it comes back down, but either way, we're looking, pretty far leap calls out on this one. If we look at the moving averages, right, we're starting to see a lot of divergence to the upside. A lot of strong divergence to the upside. Okay. Actually, you know what? Now that I think about it, let's go over the macro questions before we get to these trades, right? Because that's a little different. So let's get into that first. All right. And by the way, the macro report is out. It's live. So just subscribe if you haven't. It's free. Check it out. But let's go over the comments first. Let's actually do that first. Yeah. Well, why am I zoomed in on this? Okay, there we go. Asan, the longer they wait, the more they miss. Yeah, 100%. The longer they wait, the more they miss. People are off sides. That's been the story. The story has been that positioning is off sides. And we saw last week almost every single firm, right? S&P 500, almost all the firms are basically negative. They're all revising up their S&P forecast for end of the year. Fundstrat's the only one who has Tom Lee, has all-time highs. But for the most part, they're slowly picking up their end of year targets. And S&P just hit 4,600. Like it's just ahead of everybody. It's very positive. I think it comes down to the fact that inflation is tame and economic activity is starting to pick up. Right. And and there's a lot of cash on the sideline. So people want to FOMO in. I think it just comes down to that. I'm gonna check some of the questions here before we hit Twilio on TikTok. Let's see, any macro questions? What up? How you guys doing this afternoon, I guess? What's looking for Monday? Monday. What's it looking like for Monday? I'm really not sure. I think we're just gonna pull back. We'll look at the overall market. We'll go over the technicals. Is it just me, or does it seem like companies are hitting highs and wages are stagnating? Possibly, wages are stagnating. Wages are not rising; they're actually falling on a year-over-year basis. But either way, I don't know. You know, maybe I don't fully understand what you're really asking there, but I would just say, like, yeah, stocks are gonna appreciate a lot faster than wages. That's just the nature of the stock market, right? So earnings are not, but yeah, stocks are definitely gonna appreciate faster than wages do. There's no correlation where wages should be on par with stock appreciation, right? Totally different market. So yeah, prices are definitely gonna pop a lot faster than wages. They're not really correlated. There's no correlation where they should be one for one par or anything like that. The so-called fund managers will change sooner or later. Yeah, they will. So we got Twilio. Yeah, Twilio had the deal with Amazon. Twilio showing a really strong W pattern here, right? Now that's actually nice. Twilio has some room. You could try to enter a leap call off of this, out of this little break. Now they've had some bad. They do have. I would wait till earnings come out actually, but Twilio, yeah, for sure. You want to keep your eye on Twilio. RSI is pulling back. Those moving averages are starting to diverge. You're starting to see a golden cross there, right? The 50 is crossing above the 200 and the 100. By the way, I wanted to mention this too, because I didn't really mention this, and I'll show this in the next macro charts and during the day. When it comes to the S&P 500, 60%, 70% of stocks are above their 50-day moving average. I think it's like 68% are above their 100, and 80% are above their 200 moving average. So a lot of market breadth. Like, this market is going higher. There's nothing that can stall it that we see yet, unless there's a black swan event, or unless, oil really starts to break out and yields tighten up. That's probably about it. So yeah, that's what we got there. Now, Twilio, yeah. So Twilio looks, I would say Twilio, once you get above 80, that's a solid level. 80 is the big level, right? We saw that back in, wow, this level kind of goes all the way back to, this is what, 2016. So Twilio has a really strong resistance there. And once it gets above that level, it's a big AI play, right? A lot of API stuff going on. So if we get Twilio above 75.80, I think it's a blow off top. 75.80, 70, 75.80. In that range there, Twilio looks like a really good catch up trade, right? And ARK will also pull that higher. So you got Twilio starting to turn up there. RSI looks straight. I like Zoom. Zoom has really good fundamentals. They had a really good earnings report on the last. The problem with Zoom was that during the pandemic, they had so much growth. All the rest, because growth is measured on a quarterly basis or year over year. Once that growth came off, the stock tanked. It's still good. It's still it still has a lot of growth, but you just had that. It's kind of like Amazon. There was extreme growth during the pandemic for obvious reasons. And the company is a lot better equipped, but it just didn't have the growth it did. So if it catches up, this is going to be a nice trade. Also, we're looking at the daily chart here. The RSI is starting to pick up. And it is above R1. It's above the first resistance at 71. We're now above that level, and then now we're testing 75. So Zoom should be, me looking at Zoom, I like this as a catch-up trade. I think it easily trades back to 90, maybe 100. And then from there, if the macro improves and the Fed cuts rates, we're going a lot higher, right? Teladoc, same thing. Teladoc has some crazy options gamma, although after earnings, it kind of disappeared. But we are breaking the overall trend. On the, let me see. Is this, yeah, this is a log chart. So we're breaking the trend on the regular chart, but the log chart, we still have a little bit of room if we're pulling from the very top. Teladoc, and but it is above the support level. So this is what I'm looking at. I like this setup here. Roku is the other one. This is a catch-up trade. It already broke above resistance at 75. So I'm looking for the pullback in Roku. That should be pretty nice. I think Roku could trade up a lot, especially when with this consumer spending. We throw on the Fibonacci, maybe Roku can get back to 250. I think it gets back to 250 this year. I think it could easily get back to 250 this year if everything goes perfect, right? You have another 6 months. Big catch-up trade. That's, you know what? I'll have to say the dollar needs to break down and we need yields to come down because these are very interest rate sensitive stocks. So maybe not. But hey, think of it this way. Once the Fed starts to cut rates, all that money market fund, $5.5 trillion, it's going to leave the money market fund. There's no incentive to be there when you're going to get less interest on your money. So once the Fed actually signals they're going to cut rates, when we get, Powell said closer to 2%, I really think these stocks start to move because interest rates are going to come down and that money's going to funnel back in. All right. So let me see, what else do we got here? This is Goldilocks. Those are 3 position trades. Nvidia as the continuation trade. So we look at some bigger mega caps. Nvidia is a continuation trade. I like this. See if we look on here, basically here you see the trend it's been trending higher ever since it broke out, got to $1 trillion. It's been forming these wedges and just breaking out, wedge, breakout, wedge, breakout. So it's wedging. I expect to break out right back to the top of the trend. Nvidia continuation, right? Especially with the chips, the spending on chips. And Biden came out again and said, hey, we're going to spend on technology, AI, chips, semiconductors, all that. So I expect the government to continue spending. And I think Nvidia is one of those stocks that continues to make progress from that, or to continue to benefit from that no matter what. Tesla, another one. Tesla's in a nasty uptrend, but it's breaking the big flag pattern. You see the golden crosses, going on with the 50 crossing above the 100, the 200. I don't think this train is going to slow down. As far as rolling over, I think it's slowing down a little bit, but Tesla's showing a lot of promise also. And the Inflation Reduction Act for EVs, blah, blah, they have a lot of stuff down the pipeline. We talk about it during the week whenever new fresh news comes in. But Tesla also as a continuation, it's in that uptrend. And then AMD with the large, with the gigantic wedge here, right? Price has just been exponentially moving higher since the October lows. It got down to what, 55, 60, and then it went up 100, 110%. Now it's pulling back and it has a big wedge. So I'm looking at AMD also. AMD looks nice. AMD definitely looks nice, and it is dropping the 50-day moving average though. So I'm waiting for that. I want to see the trend actually break out. I don't want to just jump into it at the bottom because it is a little, we'll see. AMD is kind of tricky. You got to time it right. You got to wait for the momentum to come to AMD because this thing can drop out on you pretty fast. Oh yeah, we're looking at AMD right now, Hassan. So yeah, look at the AMD here. I'll do, since you really want to look at this one, we'll dive a little deeper on it. Big wedge, right? Big wedge. It's below that 50-day moving average though. Let's see if it's above the EMA. There's some bearishness on AMD for sure, but you do see the wedge, right? I'll draw that wedge here. You see the wedge forming. So I want to see AMD lift above 117. I want to see it finally get above 117. And I think that's the spot. Above 117, you're getting that market momentum. Obviously, you want the Qs to also break out too. You want to see the Qs also moving higher. I saw your comment on there, Dima Yush. Maybe the Fed doesn't cut rates, but again, inflation's at 3% headline. So we got 1 more percent to go. If we get Powell said he's going to cut rates, or he's going to pause then cut rates before we hit 2%, because that would mean deceleration. Maybe he's lying. Maybe it doesn't matter, right? Maybe it doesn't matter. But if you do, consider what he's saying, we could be at 2% in the next 3 months, right? And we need oil lower, of course, but we could be at 3% in the next 2 months. And if that's the case, then he pauses and then he cuts rates, right? Is it likely? Not with this strong market. Bond yields could take over, but if he does cut rates, right, to also lower the pressure for government interest payments. Government interest payments are at all-time highs. They're near $1 trillion. So he could just cut rates for that reason and keep draining liquidity from the market. They can do a lot of stuff. They have a lot of tools. But hey, it's possible. He said it. He just said it on Wednesday. He said, hey, if inflation falls far enough, we will think about cutting rates. Maybe they only cut 25 basis points, but definitely got to keep that in the pipeline. What's your thoughts on GNRC? So yeah, that was AMD, Hassan, and then I'll look at roadblocks right now. General Holdings, I don't know, I really don't know what this company does. It looks like it is in a bull pattern though. It had a double bottom, broke above the cup and handle. It looks bullish. It's bullish. GNRC. Jump onto the YouTube stream. So subscribe, give me some support there on the YouTube stream. And also so you can see the chart. But yeah, GNRC. Let me know who you are if you jump on too. Link in the bio. GNRC, I don't know who they are. I don't know what they do. So I can't, I don't really have a fundamental or macro view on it. But technically, it is starting to break out. Technically, it is in an uptrend, as most stocks are. Also, I wanted to point out, Oracle is one of those stocks that went to all-time highs during the whole AI chips boom, right? And it is pulling back. It looks exactly like NVIDIA did. And it is starting to flat wedge. You got a flat wedge here. You got that big gap up. It's coming back into the gap. So there's likely a lot of demand sitting there at 113. So Oracle, really nice setup. It looks, AMD, Oracle looks similar. So those are some nice possible swing trades. Not a day trade. Maybe you could day trade it, of course, but I'm talking more so swing trading here. And it's pulling into that 50-day moving average also. So Oracle looks pretty solid. All right, what else do we got? Gas at year high, and so is real estate. High interest pushes prices up in this crazy environment. Gas at year high. Yes, gas is up. Gas coming back up. High interest pushes, which is why I said we definitely need oil to slow down. You need oil to slow down, but that core could fall with shelter. Shelter comes down and core falls. And also, if you look at the housing price index, inflation is coming down for housing. It's not going higher. We went over the houses. You probably missed it. We went over the regions that are actually slowing, and the regions are increasing. So prices are down 11% in some areas. Here in Phoenix, are down 8% from the peak. So people are not selling their houses, and there's a couple analysts who actually are saying if the Fed cuts rates, housing prices will fall further. So I don't know. We got to keep our eye on that. We don't know for sure. I don't think nobody knows, but what we do know is inflation is moderating. Inflation is coming down. It's not speeding up. There's no sign that it's going up other than oil prices. Oil prices for sure. That's the big risk, and we talked about that. How is Tesla looking? They make generators. Okay, they make generators. That sounds like a what is that, like a world ending play on world? No, I'm just kidding. I don't know. They make generators. I don't know much about it, to be honest with you. Tesla, how does Tesla look? Tesla looks solid, right? This is one we always talk about. So we'll take a look here at Tesla. Well, we got the bottoming from last week, right? We came in. This is the daily chart. We came in. We've been bottoming at 255, 250 to 255. We need to get above 270 for Tesla, but we're still in an uptrend. I know this is marked up a lot. This is the gap right here that got, we had that gap up. Actually, the gap stopped right here, but we have some support there. So we're in an uptrend for Tesla. 1, 2, 3, 4. We've had 4 bottoming signals here. Volume starting to come in at that level. So I think Tesla stays above 255 as long as the overall market can chug higher. And then we squeeze these current shorts above 270, go back to the top of the trend. Hey, maybe we retrace after that. So it could look something like this. We could either break out of this trend, retest, and then come back down, find support. But once you get in this area, there's a lot of pressure, and Tesla is known for breaking out. So if you get a catalyst, if you do get a catalyst above this 315 level, it's very possible that Tesla breaks out, retests a little bit, and just goes to 385, 400 all-time highs. That's a very big possibility, just given how many shorts are stacked here, how many people hate the stock. It's positioning, right? It's positioning, overweight cash, FOMO, full self-driving, right? There's just so many catalysts, but it could just stay in this trend. If we break, then we're going to go back and retest 235, where I think there's a lot of buyers still waiting to sit there. So overall market goes up, these stocks are going higher, right? S&P keeps chugging higher, Qs keep chugging higher, we're going higher. There's no doubt. And we did see the Qs actually show support on this trend from early June or late June. Okay, there we go, late June. And yeah, well, actually, no, this trend we've had this trend in place for a while, to be honest with you, since May. So the Qs are just rolling along, right? Not slowing down at all. Biggest risk is oil really starting to break out. So we're going to keep our eye on that. Hopefully it stays between 83.50. All right, what else we got here? Did Wells Fargo get out of the mortgage business? Did Wells Fargo get of the mortgage business? I don't know. But a lot of the commercial real estate is just going to get rolled over from what I've seen. And it's just going to get rolled over. There's not a whole lot of risk. That risk will come back in. Maybe we slow down in 2024. But real estate risk, the commercial real estate sector is not as large as residential. If residential were to roll over, we'd be in trouble. But that's not happening because people don't want lower rates. They're not really selling their houses at a fast pace. They have a lot of money because they can borrow against their houses, and housing prices are up. So housing prices being up might be a negative, as in, oh my God, it's slowing down housing, but also people feel richer. People are going to spend more because their houses are worth more. They can borrow against their house, and that's been a historical correlation for consumers being confident. So it goes both ways. Nothing really changes here. It's just, are we getting progress on inflation? And is growth picking up? And remember, GDP has been revised higher. We looked at that. GDP is starting to revise up. So you get GDP going up and you get the bottom of earnings. That's it. It's on fire. I think we're going to start seeing earnings bottom. Tesla beat top bottom line. A lot of companies are beating top and bottom line growth, period. Especially the bottom line growth. That's the one that counts the most. Do you see a bounce on Disney? Actually, one of my buddies is long Disney. He just took some leap calls, some 2024 leap calls on Disney. Strong bottom at 85.50. Disney looks good. Disney looks solid. Yeah, Disney looks really solid. I mean, your stop would be below 84, right? If it gets below 84 and holds there for maybe a day, it closes below 84. Maybe it's it's going to keep trending lower. But Disney on the RSI is starting to. The RSI is consolidating at the lows, so you get a small catalyst, or the market keeps going up. Disney will pop. Disney will eventually pop. But it is, it's pressured. So you got a tight stop, or you wait for it to break this 91 level. You either wait till it gets above 91, or you try to, play the support with the stop below 84. That's how I look at it. That's why I see that. But Disney looks solid. Yeah, Disney looks really good. Look at this whole market is going up. The whole market is going to continue to grind higher. We see market breadth absolutely everywhere. Even the equal weighted stocks are pretty much going higher. Like everything is moving up. This is not a bear market. Whoever tells you that, something's wrong with them. Something is wrong with them. What are they saying? We're in a bear market till we get to all-time highs and break out. Good luck. You're going to wait 20% to the highs and then say we're in a bull market? That makes zero sense. Once you break the trend, you're in a technical bull market, right? Once you break the trend, you're in a technical bull market. Money managers see slow growth for a while, so I would watch PEs when you buy. I'll say this, Dimayush, PEs are relative to the sector you're investing in, obviously. And with Biden, just think of it this way: price to earnings. Earnings are going to go up. I see you in there, Dimaj. Earnings will go up if Biden keeps spending. We see industrials at all-time highs, right? Where are the industrial stocks? I love the questions. Please challenge me. If you think I'm wrong, let me know so I can explain it. Right, let me explain this. But anyways, industrials all-time highs because they lead you out of the bear markets, right? They're leading economic indicators. We're onshoring infrastructure, our manufacturing, we're onshoring the supply chain to US. Biden is still spending. There is no recession in sight. There is no recession in sight. Maybe that turns, right? Maybe oil goes to 150 and they have to raise rates to 6% and crash the whole economy just for oil. I mean, I don't know. Well, we'll increase production before that, but I just don't see, us diving back to the lows. Maybe we consolidate here, possibly. But you see money managers see slow growth for a while. Yes, and that's okay. The market doesn't care about slowing growth. It cares about negative growth. The market's okay with slowing growth because that means yields come lower. That means bond yields come lower. It's all about inflation. And then also with the whole PE narrative, it doesn't matter. PEs don't matter. Price to earnings don't matter when everybody's offsides and chasing. Obviously, they haven't. When people are chasing because they're offsides, because they're positioned negatively, because they're missing out on the rally, because they have to buy, NVIDIA, AMD, Apple, Amazon, whatever, the PE doesn't matter. It matters once people are positioned all the way in. Once people are fully positioned, the PE starts to kick in. If that weren't the case, you wouldn't see Amazon, Apple, Google, Facebook, all these big, mega cap tech stocks that have had P's in the 50s and the 80s and the hundreds for the last 6 years and still leading the market, right? Because they're innovating. So PE is important, but it's timing. When does PE matter the most? Sounds like you're a little bearish, Dima, and that's fine. You can stay bearish, but this market will continue to grind higher because people are off sides and because the macro is starting to improve and the fundamentals are improving. We're seeing S&P earnings start to bottom, right? The economy is starting to bottom also. So that is the case. I think recent spike was due to recession expectations. What do you mean, Dima? Where do we stand with Verizon? Huge market cup, massive lows. If not now, it's no point in entering the stock. Oh, Verizon. Okay. VZ. You know what? I'll tell you this. I don't like Verizon. I think there's something intrinsically wrong with their business model. I think they're being disrupted by a lot of other communications. I think they're trash. I know they have a nice dividend and people like them, but if you're gonna get a dividend company, like maybe it bounces, right? There's a lot of consolidation down here, but price might, if it goes to all-time highs, it goes up. What? Oh, I guess it has a lot of room to grow. If you like a falling knife, it could bounce here, but I don't like Verizon. But I'm more of a growth position trader. All right, I'm not like a dividend guy. I'm definitely not a dividend guy. Maybe if I had like 10 million or 5 million to throw into a dividend, yeah, it makes sense, but definitely not me. So, yeah, I don't like Verizon. I mean, if you do, you got to see some support, and if it's for the dividend, I guess it doesn't really matter. But what if they fail, right? I think they're getting disrupted by a lot of Starlink and a lot of other stuff coming online, so they could be just a nice dividend play. You got 25 to 30. I think Verizon looks like it's going to drop to about 30. That's what it's looking like. All right, I got about 8 more minutes, so you guys throw in your questions, challenges, concerns, whatever it is. Got about 8 minutes left. Oh, Bitcoin. Yeah, we didn't even talk about crypto. Look, crypto is sleeping. Crypto is sleeping right now, but crypto is gonna rip. Crypto will start ripping. Rates are elevated, so that hurts crypto. The dollar rollover should help crypto go up. MicroStrategy finally starting to rest here. It's showing an entry point, but I'd wait till earnings. Who knows what can happen with MicroStrategy? That thing's been up insanely. A lot of these stocks, I think there needs to be a pullback in some of these stocks. But yes, crypto, great question there. Where's Bitcoin? Let's take a look at Bitcoin. And the narrative's still the same. Everything's the same, right? With crypto, it's an evolving narrative. We'll see what happens. But Bitcoin dropped the 30K level. It's still consolidating. It can rip higher. It really doesn't matter. It's still in, it's still with the trend. The trend is still in play. You're still in play with the trend on the log chart. But for Bitcoin to really show some promise, it needs to get above 31, 32K, right? We need to get above there. Okay, 40% of your money in Bitcoin. Bro, Bitcoin will go higher. Let's just throw out the narrative for Bitcoin really quick, right? For crypto. Oh, my bad. Roblox, you're right. RKLB. I don't really need to look at the technicals for Bitcoin. My bad, Hassan. Roadblocks looks good. So let me go over this Bitcoin narrative since I'm already on it, and then we'll go to Roadblocks. I totally forgot. So for Bitcoin, you have 2 catalysts: regulation, the Bitcoin ETF. Once there's any bit of once there's any bit of like positivity on regulation or the Bitcoin ETF, it's going to bid up. It's going to bid up. But if you're looking over the next 6 to 12 months, like BlackRock is filing for the Bitcoin ETF, there's a lot of money in it. A lot of asset managers, family offices, institutions want exposure to Bitcoin. They want exposure to DeFi. There is the narrative for tokenizing pretty much everything that will come into play. You just got to sit in crypto. That's why I don't really go over the technicals, because at the end of the day, once it starts ripping, that's it. It's very volatile, but once it starts ripping, that's it. It's going higher, right? It has its own narrative, and I think you just got to be patient. You just got to be patient with Bitcoin right now, especially Ethereum. Make sure you're in the right projects. Bitcoin, Ethereum, Chainlink is our top, holdings right now. So yeah, just be patient with Bitcoin. That ETF, there'll be some news that comes in eventually, and the longer it consolidates above 25K, you're good. 25K is really what we need to hold. So yeah, there's probably people trying to short it right now. So we'll see what happens. So roadblocks are I'm sorry, this is not roadblocks. That's what I thought it was roadblocks. Rocket Labs. I do not like Rocket Labs, man. These things, this is Asan. This is there's some tricky stuff here because they do one launch. Keep this in mind. Once they launch, you got to be careful because if the launch fails, they usually tank, just like SpaceX, space, right? Virgin Galactic. So be careful with Rocket Labs. I don't know why I thought this was roadblocks, but technically it is on the next trend, right? It's holding on the trend around 670. These things are just tough. They're really tough to trade. You kind of have to go YOLO. You have to go YOLO and just hope it goes higher because there's no really true trend. The next resistance is above about 7. So I would say personally, as a whole number, if Rocket Labs can hold above 7, and you see intraday that it has multiple touches or maybe a strong touch with volume above $7, yeah, it goes higher. But I would stop out under 7. Under 7, that thing could tank really bad. And earnings are coming up August. It's just tricky, Asan. I don't like those moves. Right after earnings, I would reevaluate. After earnings, reevaluate. Okay, where's there an entry? But the earnings are just, man, they could be volatile. So you just got to take that in consideration. Looking at Rocket Labs. What up? How you doing? I need to see pullback to be bullish. Yeah, Dima Yush, a lot of people want to pull back, and that's my point. People are waiting for the pullback. So even if you get some negative news or there is a technical pullback, there's going to be FOMO coming right back into the market. The market internals are very solid, like we went over. Okay, the market internals are solid, and I think that continues. You also said now recession, but instead slow growth. Yeah, no recession, slow growth. But like I showed earlier on you can't see it, but we went over the whole slow growth. GDP is starting to recover. So last quarter we came in at 2%. We're at 2.4%. So GDP is recovering. Expectation was at 1.8%. So we're beating expectations, which means that growth is slower. Don't get me wrong. The jobs, payrolls, growth is slowing, but it is starting to rebound. If you look in the back, it's starting to rebound, right? Led by services because most of the economy is consumer spending. And the stock market will lead that. That's why we're still bidding up, right? That's why we're still bidding up. Equal weight is up. So we're looking solid. But it is possible we get more inflationary pressures or a rebound in the second half just because commodities might come back up. That's always a risk. Commodities might come up. Oil prices might come back up a little bit. But if you do get enough supply, I don't know if it matters. We'll see. The Fed could just cut rates or, use their balance sheet, or maybe, Joe Biden just keeps spending. So we'll see. Any questions on that? Yeah, you're welcome. No problem. Did you figure out what Egan layer was? No, I did not figure out what Egan layer is. I didn't look into it. I didn't look into it. You should write about it on our website. There's just so many things to look at. So Egan layer, I mean, I'll take your word for it. It sounds interesting, but I don't speak crypto as much as my brother does. Give me what the number one thing is for Egan layer. SCHD jump 2. So core companies I feel are catching up to tech. SCHD. Oh, you're talking about Schwab dividend ETF? Schwab's US dividend ETF, equity ETF. Yeah, that's just that's another that's basically fixed income. Fixed income is starting to Jonathan, fixed income is pulling up. That's a good sign. You're getting fixed income and people would rather get, and that's why we're seeing what is it, high yield equities move up because people are more interested in, it looks like anyway, they're taking more risk into high yield, or how would it, not high yield, they're taking more interest in fixed income from the stock market than from the bond market. They trust stocks and equities more than they do the US government. Very interesting. You see that with the triple B spreads. So that's just the case. That's what we're looking at. And this is a good time to buy, I guess you could say, high yield, because we're at the bottom of the market. So if let's say I was going to do it, let's say I had 10 million and I want to, collect 100, 50K on a 5% dividend. I want to collect 50K a month just by sticking it in the dividend. You want to do that at the bottom of the cycle, which we are at, not at the top of the cycle. But yeah, we're almost at all-time highs with Schwab dividend. Everything points to a higher market, and eventually you're going to see crypto breakout. The risk appetite for crypto will come in. It's going to come in quick. It is going to come in quick. We're in a bull market, so here goes crypto. We're also looking at what is it? We have, where'd it go? Obviously, Chainlink. Yeah, we're going to keep our eye on Chainlink. Total crypto market. Yeah, when crypto starts to catch another narrative, we'll look deeper into it. But right now, it's just resting. It's sleeping. And if I still had more cash, I'd still be buying. I'd be buying Ethereum and Bitcoin. Pretty simple. They are an oracle that gets the price from liquid stealing derivatives. Oh, Egan Layer. Okay, Egan Layer. I think you're talking about. So Egan Layer, they're oracle. So my brother did look into it. How about Open? Okay, yeah, we'll look at Open. Egan Layer is staking. Okay. They are an oracle that gets the price from liquid staking derivatives. Interesting. Okay. And my response to Egan Layer would be great. It might be really good, but I think Chainlink solves all that. Chainlink might solve that better than Egan Layer. And the thing is, I don't know about Egan Layer, so maybe it's a really good project. I wouldn't be the guy to actually look into it. How about Open Door? Okay, yeah, Open Door is still solid. If you're holding Open Door, like I said before, I got stopped out back then. You just hold it. It's going to go higher. You see the ITFB, all the home builder ETFs are going higher. You just hold the shares. No options on here because it's a $4 stock. You're not going to get much beta trading long options. You need bigger price stocks for that. So you just trade the shares, you hold Open Door. I mean, it's probably going to go back to its opening price at $10. And then you can see from there in the next earnings. But Open Door, yeah, Open Door is a solid pick. It's a riskier type of asset. So yields come down, it goes higher. There is more safety floor, dare I say, soft landing happening. Everybody's afraid to say soft landing, but that's what's developing. I mean, why are we scared to say that? That's what we're seeing. We're seeing GDP bottom out. We're seeing an earnings bottom out before that, but we're seeing the consumers not giving up. They're flushed with cash. Their incomes are not falling apart. There's enough jobs. This is all fueled by fiscal policy. Nothing is not going anywhere. We're not going anywhere. They're like, how many times do we got to show the chart? I don't want to say how many times, but just in general, let's just talk this through. Okay. I'm going to bring these charts because I'm going to bring this to an end in a couple minutes. Open Door looks straight though, just to keep it clear for you, Asan. It looks like $4, and I know I'm jumping all over the place. Looks like $5 is going to be that next resistance for Open Door, around $5. Yeah, I think $5. It's just very vertical, so maybe a sharp pullback into that trend. It looks a lot like Rocket Labs, kind of a similar type of asset. So yeah, 440 to 5. I want to see consolidation. The moment I see consolidation on Open Door is when I'm like, all right, I'm interested again. I just don't want to chase it. It's up a lot. All right, so why soft landing? I'm still holding BTC, Solana, Polkadot, AVAX, Atom Bomb. I'm just kidding. I don't know what that is. ADA, As for crypto, yeah, those will all go higher. I feel like there's more. So people are scared to say soft landing, but that's just because they have recency bias. They remember they almost need a drop. Oh, you're good, Asan. Yeah, hold that. Just hold it. It's going to go to 10 eventually by next year. It'll go 10. The Fed's going to reverse course in 2023. I mean 2024. They'll pause this year. They are going to pause this year. They're not going to keep hiking rates every meeting. They'll pause this year. The only way they do is if oil goes up, and I don't even know if oil is the problem, right? Because that's more volatile. It could be just core, but core is not going higher. So like I said, GDP's up. It's starting to go up. Earnings are starting to bottom out. The rate hike's already in. Like I said, the whole Goldilocks thing is just that Biden keeps spending, right? And that's kind of how investors feel right there. That is it. Keep on spending, Biden. The more you spend, the more earnings growth come into a lot of the industrial manufacturing, even technology stocks, chips, AI. They're spending for that. He just talked about it the other day. The Bidenomics. He keeps doing it. Forget your politics. Money is coming into the market because that's how you stay afloat in the world, right? We're going to keep our dominance. We need to remain our dominant. We need technology. We need better technology. So that's not going to change. And then you have Powell hiking rates, but he's at the end of the cycle and he's very optimistic about the economy. And he said that. And if inflation gets to near 2%, not 2%, it needs to get near 2%, he's going to reverse course. And the other problem is the interest rates for the federal government are too high. So they have to reverse course at some point because the interest payments for the US are actually larger than how much they spend on defense. That's not sustainable. So at some point they need to cut rates. They need to cut rates to not so that the debt, or so that they need to cut rates in order for the payments to not pull from GDP. They need to cut rates. It's going to happen. It's going to happen, right? And let's say it doesn't right away. Well, technology increases productivity and then you get GDP from there. So either way, the market goes higher. Either way, the market goes higher. You need a black swan. You need oil to explode. You need inflation to come back up. That's the only way that it really gets knocked down. And we've been saying this for a long time, and it's playing itself out, right? Again, biggest risk is oil prices, but it's happening. AI is such a buzzword now. New GPT update wasn't so great, right? But that's one, right? Jonathan, that's one. GPT is one of the AIs. You also have Google Bard. You also have you have Microsoft's whatever Microsoft's doing. There's AI. ChatGPT was kind of just like, it was like the tickle. It set things off, but now you're getting AI into everything, right? Not just a chatbot. You're getting into everything. Everybody's using it. Big tech's been doing AI for a while also. So it is a buzzword to get price up, but it is not fake. It is going to bring the most trillions of dollars of GDP over the nobody's debating that AI brings more GDP, more productivity. Nobody's debating that AI is an atom bomb, right? If you watched Oppenheimer, saw it this weekend, finally they're giving him his credit. That was a really good movie, by the way. Go check out Oppenheimer. A lot of dialogue there. Really good, interesting movie. And AI is the next atom bomb that's just going to change the world. It is changing the world. You just don't see it, right? It doesn't happen right away. When they first started the atom bomb, it took 3 years. It took 3 years for them to actually release it. So it's going to take time, but the markets are forward looking. They're saying, oh, shoot, okay, earnings are going to keep revising up, right? The most bearish guy in the market, well, we're not talking about those guys who are, anticipating a nuclear war, but the most bearish guy in the market is already saying that 2024 earnings are going to explode. That is Mike Wilson. So if we get to the closer we get to 2024 and earnings don't fall apart, all that cash, all that gunpowder right back into the market. We're going much higher. So that's what I got for you guys. It's the playbook is this. The government keeps spending and the Fed keeps inflation tame and the market goes higher. That's pretty much it. And we're watching the technicals to confirm that. So that's the game plan. You just got to pick the right names, right? Pick the night, be patient. Don't be stupid and try to trade your way out of this. This is going, I mean, when I say trade, like Don't take so many trades. Just hold your investment positions, take some longer term leaps in the right names because the market's going to be choppy. It's not going to go straight up. So unless you're a really good trader, which is not most people, just stay patient. Of course you saw Barbie. No, I'm just playing. Yeah, it was Oppenheimer was a good movie. It was a really good movie. I loved it. All right. Well, that's all I got for you guys. I will be back on Monday. Like I said, my brother's having a baby this weekend or this next coming week. So this might be our last macro report live. And I don't know. We'll see how it goes. I'll be traveling, won't have my equipment, but I will be here on Monday. So I just don't know. Thank you guys for the good questions. I appreciate the questions. And whenever catches AI technology first will be superpower. Exactly. Whoever catches AI will be the superpower. That's why the Biden's going to keep spending. And if it was Trump, he would be doing the same thing. There is no, you know what I'm saying? When it comes to survival, there is like, the economy. You have to have a strong economy. You have to have technology. That's how literally you innovate. That's how superpowers stay in power, whether it's military, AI, whatever it is, it's going to continue. Yeah, no problem. I appreciate you guys jumping on. Have a great weekend. I'm going to shut it down. I appreciate you guys. Will be back on Monday. And stay blessed this weekend. Stay safe. If you watch the fights, don't drink too much. Have a good time. Shout out to Gaethje. All right, you guys stay blessed. I'll catch you guys later. Oh, don't forget the macro report. If you haven't subscribed, check it out. Link in the bio. It's free. Right? We talked about it. Go check it out. Help me out. Subscribe and support your boy. Again, appreciate you guys.